Last thing, we hear about index funds. Uh, Take a little bit of the sparkle off of that. What
Yes.
is it?
So there are a bunch of different indexes that make up there are a bunch of different businesses that make up kind of a a sector of the market. So I'm going to mention S&P 500. A lot of people are aware of it or they've heard of it. The S&P 500 are 500 large cap companies. Large cap meaning very large, over 10 million, 10 billion, and
10 million what?
$10 billion, over 10 billions of market capitalization, which is another term, which is it's the number of shares times their price makes up their market cap.
Okay.
And the S&P 500 is an index that matches how well those 500 companies are doing. So an index fund is going to be a fund that matches one of those indexes. You can't actually invest in the S&P 500. That's just a metric to show how are these companies doing as a collective 500. There's other ones, Dow Jones, which is 30 companies, the NASDAQ, which is usually more tech heavy and is more volatile. But it's a grouping of companies that make up an index. An index fund is being able to invest in some type of a fund that is trying to match that. And so one of the best ways to invest in that is through what are called ETFs. And they're kind of a fairly new creation. And ETF is electronically traded funds. So unlike mutual funds, which buy and sell at the end of the day, you can buy ETFs throughout the day. Just like a stock, the price varies throughout the day, from the beginning to the end, and anywhere in between. You and I could be on the computer at the same time buying this, and we would get a different price because it's constantly fluctuating. Well, there are a lot of ETFs out there that match pretty much identically the indexes, maybe a little variances here, and they're funds that are managed very offhand. Like there's no active manager of the fund. It's basically run by a computer, an algorithm that's looking and making sure everything is being bought and sold so that that fund matches the index that it's supposed to follow. And because it's just run by a computer and an algorithm to match that, the fees on those are incredibly low, like 0.02%, which over the long term is very minimal compared to maybe a 1% that a manager might take. Or I was in a fund before I kind of got into this, it would take a 5.5% every time I put money into the account. So I would have to make up 5.5% before I would make any money. ETFs aren't going to work like that. They're very cheap, and they're disrupting the industry as we know it over the last 10, 15 years, and really making individual investors like us to be able to invest in an index fund and match the returns of that particular index.